the best mutual fund manager of his generation, a man who compounded money at roughly 29% a year for 13 straight years, wrote a whole book with a strange confession inside it. You, the amateur, standing in a checkout line, holding a product you love, had the information before he did. Not sometimes, routinely. His wife found one of his best stocks in a grocery aisle. The question is not whether ordinary people see winning companies early. You do, constantly. The question is why you never make a dime from it. The question is why you never make a dime from it. The question is why you never make a dime from it. The book is One Up on Wall Street, published in 1989 by Peter Lynch, who ran Fidelity's Magellan Fund from 1977 to 1990 and turned it into the most famous fund on earth. And instead of writing a victory lap, Lynch wrote a field guide for civilians. His argument fits in one sentence. The professional's advantages are mostly myths, the amateur's advantages are mostly unused, and the difference between seeing a great company and profiting from one is a repeatable set of homework. First idea. Wall Street learns about companies through quarterly filings, conferences, and each other. You learn about companies by living. The nurse sees which drug the hospital actually reorders. The contractor sees which tool brand took over the truck. The teenager sees which store ate the mall. Lynch calls this the edge of the amateur, and he means it literally. By the time a hot company has enough analysts covering it to reach the evening news, its easiest money has usually been made. The people who were physically standing in the store got the head start. Then, and this is the tragedy Lynch is trying to cure, they spent it on lottery tickets and rumors instead of the company in their own hands. Second idea, the discipline that turns sightings into returns. Know what you own and know why you own it. Lynch sorts every stock into 6 species: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. And the whole point is that each species lives and dies differently. A cyclical bought like a stalwart will ruin you on schedule. A fast grower sold like a slow grower will cost you the 10-bagger. Lynch's word, his own coinage, for a stock that pays back 10 times your money. His test is brutal and fair. Explain the company to a child in 2 minutes. What it does, why it wins, what could kill it. If you cannot, you do not own a business. You own a 3-letter symbol and a prayer. Third idea, the anchor under everything. Charts seduce, stories inflate, but in the end, earnings drive stocks. Price can detach from profits for quarters, even years, and Lynch's cocktail party theory maps the detachment. At the bottom, nobody at the party wants to talk to the fund manager. By the top, strangers are giving IMI stock tips, but gravity never files for an extension. A company that keeps growing its earnings will eventually drag its price up behind it, and a company that does not will eventually drop the rope. The amateur who simply holds good businesses through the boring middle beats the professional who trades the noise.